Thanks everyone for attending today's webinar hosted by the WA chapter of the Australia-Israel Chamber of Commerce and event partner, national real estate company, the Agency Group. Shortly, I'll be welcoming John Kluwer, CEO of AICC WA, to give an introduction. But before I do, I'd like to run through a few technical matters. Firstly, this webinar is designed to not only be informative, but also be very interactive. We want you to ask questions, and for the hundreds of real estate agents on the webinar, send through any anecdotes you have that support or dispel some of the things we're covering today. To submit a question, please use the Q&A button on the bottom of the screen. The webinar is being recorded, so if you miss anything, we will be making a copy available in the coming days. I'd now like to introduce John Kluwer, CEO of AICC WA, to give the formal introduction. John, over to you. Sorry, John, we may just need to unmute you.
Right, I think we're right. Hello, everybody. On behalf of the Australia-Israel Chamber AICC President, Mr. Graham Late, and some of the board members, including Larry Lopez and Paul Neodoni, Hugo Bombara, and John Schaefer in attendance today. It's my absolute pleasure to welcome you to stage one of the AICC's property event of the year. Stage two is planned later on in the year when we can get together in person. We have a big quality audience in attendance today, 250 plus probably another 100 being streamed. So thank you to our hard work of the sponsors, our partners, the Property Tribune and Living Online, and also the agency have been working hard with us to put those on. Today, we follow the very strong tradition of great speakers of the AICC. Thank you to Gavin. We just might pass on that slide for a second. Thank you to Gavin and to Tim for scheduling the AICC into your calendar for today. Look, we're very fortunate to have both of them in tandem. And for any of you who haven't seen Gavin and Tim in tandem, you're in for a special treat today. I can assure you, you'll be very impressed with their research insights and commentary. We can hold that slide till a bit later on as well. So yes, get your questions ready for later on. So for those who don't know, the AICC is, we stimulate bilateral trade, intellectual exchange, and the knowledge economy between the states of Israel and Western Australia and all of Australia. We are really matchmakers and connect people and do this by one-to-one schmoozing when we can, and take delegations to Israel and through high-profile in-person events. And locally, we do events and nationally. So we're apolitical, we have no religious affiliations, and we operate in all Australian capital cities and Tel Aviv. Have global reach, and anyone can join the chamber. We welcome new members every month. So why Israel, some of you might be thinking? This is a tiny power-packed country. It's a high-tech country. It's a size with 9 million people. It fits into a size, the area from Yanchep to Mount Barker. And it continues year on year to attract R&D investment and continues to find success with its startup economy and its enterprise, which comes out of the startup economy. It seems to maintain its global rating every year and continues to produce a balance of payments, annual surplus ranging between 3 and 4% of GDP, and is consistently positioned in the top two, the world innovation economies. It really is a high-tech powerhouse and an innovation lab for the world. So with that in mind, that's why we exist. Australia is looking for new economies, and indeed, we have a trip going to Israel based on new economies next year. The WA Premier has made it a platform to have new economies in WA, and we're currently planning that trip along with others. And that's our purpose. We have a wonderful mandate to link us with Israel and vice versa. Others around the world know about this, and if you could flick the slide up with the multinationals that are in Israel. There's a slide there, that one there, just have a look, you'll recognize some of those names. There's no Australian companies on there. We got close with Woodside and with Singtel Optus, but you'll actually walk down the street in Tel Aviv and you'll see these companies close together, and there's over 400 in Israel. So economically, 2021 was the most astounding year for Israel's brief economic history. The following stats support why the Israeli shekel has risen to be one of the highest values currencies. Israel is the fastest growing economy in the OECD, recording 8.1% in 2021. Our own Matthias Cormann has just been to Israel to have a look at that country. The GDP growth in the fourth quarter was a whopping 16.6%. Also of note, 8% of global unicorns, that's private firms valued of over 1 billion, are held in Israel, and that's with 0.1% of global population. Now, if you're interested in reading more about Israel, I'll move on, but there's a book, there it is, Startup Nation. And now, perhaps one of the industries that you didn't really know that was growing in Israel for the world is called property tech. Israel now has 100 startup companies developing technology that is specific to construction and the build environment. And globally investment into the property tech new economy was estimated to be $5 billion US a few years ago, and it's growing pretty quickly. And so Israel is fast becoming the leading address for innovation in property and construction. Now, anyone interested, connect to me and the AICC. Now, Gavin and Tim have a lot to cover in an hour, so in just a moment, I'll hand over to our principal sponsor, the agency group, for an introduction of both speakers. But first, a big thanks to today's event sponsors. If we can just see the slide, I will be properly introducing these people in our event in person at the end of the year. But welcome to the new sponsors there, the Property Tribune, Living Online, and Bendigo Bank. So thank you, the agency, our principal sponsor. Now, now it's my absolute pleasure to introduce Paul Neodoni, who's been with the Chamber over 16 years. Thank you, Paul, for your support today. And I'll hand over to you to introduce our two keynote speakers. Thank you. Over to you, Paul.
Thank you, John. Welcome, everyone. It's a great pleasure that the agency has sponsored this event, the second, in fact, property event with the AICC. As John said, it was unfortunate. We'd hoped that we would have had 260 plus people in a room today, but with COVID restrictions moving and changing quickly, we had to resort it to be online. I think today's going to be quite exciting because, as I've said always, we get bombarded with news clippings and snippets on what's happening in the property market. For those that are in the property, you get asked a question every day, and we've got to try to put all this information together. The latest headline in the Fin Review the other day with, I think, the chief economist of ANZ was that housing values will drop 8% in 2023. Now, one of the issues that I've always had is that obviously we get a lot of stats that are national based, but we know property is very much localized. And that's why the event that we're having today is very important, because we're bringing together probably the two most preeminent speakers and commentators and researchers in the industry, in both Gavin and Tim, not only to comment on national trends, but to dig down deeper and look at what's happening locally. And that's where we hope also to get some of your feedback. It's a market that's changing fast. We've got COVID restrictions coming and going, lockdowns, talk of interest rate rises, war in Europe. It's amazing. And yet we've got strong commodity prices. We've got shortage in labour. So we've got a lot of factors from a macro level and a micro level mixing together. And I think today's presentation is going to help us to decipher some of that information so we can answer a bit more confidently when someone asks us, what do we think is happening in the property market? So without further ado, I'd like to introduce our speakers and start the seminar. Thank you, Gavin, and thank you, Tim.
Thanks very much, Paul. I think I always look forward to these sessions, especially pairing up with Gavin as the local market expert. I think everyone would agree. So, Gavin, I think you might be leading the session.
Yes, hopefully you can hear me now. You've got me on unmuted. I've unmuted myself. Great to speak with you, Tim, and welcome to everybody today. And we look forward to a really robust discussion from both the points that Tim and I are going to discuss, and we've got a range of things to discuss here. And also, for your points that you raise on the way through, please feel free, send them through as they pop into the mind, and so we can get them recorded. And if you have a statement, a comment, or a question, we welcome all three. So please bring them online, and so we can address them. We're going to cover a range of things here. Obviously, there's a lot happening in the property market, has been outlined already. We've got borders opening. We've got interest rates moving. We've got different markets in Australia out of alignment. We've got building costs rising. We've got a number of things. So, Tim, if I could start with an obvious one, which is you're over the whole Australian market. It's great to see. It's great to see you dressed up too. I'm glad to see you've got the coat on there. That's really, really good to see. I didn't put the coat on today because we're at 39-degree day here in Perth. But on the housing market in Australia, we've seen a boom, classic boom over the last 12 months. We've seen almost somewhere close to $1 trillion being added onto the balance sheets of the housing market in Australia in the last 12 months. But perhaps we've seen a bit different scenario in Western Australia and Perth. Perhaps if we could start, perhaps how are we seeing around the country, but how's Perth looking relative to the rest of the country according to your stats?
Yeah, absolutely. Thanks, Gavin. And I didn't quite go as far as putting a tie on today, but I feel like I'm in Melbourne, even though I'm in the Sunshine Coast, because it's been pretty dismal up here with all the rain and flooding. It's to focus on the market. Obviously, we've moved through what's been quite not quite an unprecedented boom, because we have seen conditions as strong as this, if not stronger. But we've just moved through a housing cycle, or a peak in the housing cycle, that's been significant. We've seen housing values around Australia have risen by about 22% over the past 12 months. The last time we saw growth rates of that magnitude was back in 1989, which for any of the older folk around, the more mature age folk, that was a time of deregulation of the banking sector, and credit availability was really starting to change. But interest rates, of course, back then were massive. They were up around 17%. This growth phase has been very different. We flick onto the first slide, you'll see what I mean. This is a cycle that's been, well, at least at the beginning of the pandemic, it's been very synchronized and very uniform. You can see that the rolling quarterly change in housing values across each of the capital cities was pretty much tracking in line regardless of where you are over the first year or so of the pandemic cycle. But more progressively, as we've seen conditions changing around, say, affordability or state policies, or we've seen fixed rates starting to rise, of course, we've seen a lot more diversity coming into the marketplace. You can see that really clearly, especially the graph on the left that looks at the rolling quarterly change in housing values across each of the capitals. We've seen markets like Sydney and Melbourne slow down really sharply, but areas like Brisbane and Adelaide quite insulated. And then Perth, I put in a whole different basket because, in markets like Sydney or Melbourne, the market has been slowing because of affordability constraints, because of a real demographic headwind facing those markets as more people move into state or to regional areas. Whereas in WA and Perth, we know that this is one of the most affordable markets you can buy into. In fact, it's the most affordable of any of the major capital cities. It's got a very strong economy. It's got unemployment below 4%, jobs growth up above 6% year on year. And we know that getting into the market, particularly for first home buyers, is a lot easier than what you might find in the very expensive markets like Sydney and Melbourne. On paper, we'd be expecting the Perth market to be doing a lot better than what these statistics are showing at the moment. But maybe the reassuring side is we are starting to see that rate of growth actually rebound. In fact, Perth is the only market where we're seeing some renewed momentum coming into the marketplace, whereas every other capital city is generally in slowdown mode. So I think even though we have seen the market slowing down, and that slowdown in Perth seems to coincide fairly closely with the closed state borders, which has interrupted the interstate migration flow and housing demands. As we see borders reopen, we are expecting that level of demand flowing in from interstate should start to improve, and maybe we're already starting to see some signs of that.
It's interesting, Tim, because it's a classic housing cycle, which is not operating on a uniform basis right across Australia. And once again, perhaps Western Australia finds itself outside of that cycle. And it's just interesting. If I look at where housing prices tend to sit in the longer term, Perth certainly is sitting relatively lower than where it sits in the longer term. It normally sits around about fourth place, median prices in Australia, given all of those factors you just mentioned, plus the size of the population. And I just looked at some numbers there. If we're sitting somewhere around 559,000 average house price, for instance, median house price, and we move to fourth position, which is our normal place from being the most affordable into the fourth position, we'd move to somewhere around about $800,000, which is a lift in price, median price of just shy of 43%. Do the same thing with apartments. 401,000 becomes $580,000, a lift of somewhere around 44%. So similar lifts of somewhere around 40% just to put us into place where our normal place is in fourth. Now, there's obviously two ways to come fourth. You can have a few people drop away and have a drop away at the top, or we can rise from the bottom up, maybe a combination. Suggests there seems to be a lot of potential for lifting our prices just to get back into a position relative to the rest of Australia.
Yeah, absolutely. Let's just flick over to two slides, to slide 12, and we'll see exactly what Gavin is talking about here. We look at median values across each of the capital cities. You can see Perth right down the bottom of this leagues table, right? As Gavin says, a median house value of about 560,000, a little bit more expensive for apartments, but the density side of Perth is still a fairly small component of the market. So I think we can argue very, very easily that housing is very affordable across the Perth marketplace. And just look back to say where the market was in 2006. Okay, we all remember what was happening back then. We'd just seen housing values in Perth rise by about 40% in a year. And arguably the market was overvalued back then. Absolutely, I'd agree with you that the market is currently undervalued. You'd think normally Perth would be around middle of the pack, if not even a little bit higher than middle of the pack in some cases. So yeah, I certainly support your view, Gavin, that I think the market has some way to go in rebalancing back to where the fourth largest capital city in Australia should be. That doesn't happen overnight, and it doesn't happen magically just because that's where we think the Perth market should be. It generally comes back to the underlying fundamentals of the market, which we know in Perth are still quite strong, and also the broader economic factors, which again, we know are quite strong as well. So I'd probably argue that even though at a macro level, we are looking at housing market conditions that are broadly slowing, we know that Perth is quite often counter-cyclical. It tends to move in sometimes opposite directions as the rest of the other capital cities, depending what's happening with factors like the commodities sector, migration rates, levels of unemployment, and so forth as well, which we know is quite strong at the moment.
Yeah, it's interesting too, because we've had a really almost a scattered boom, and I've lived through probably 4 booms in the market now and 3 busts. But this boom seems to be quite scattered. And this boom was all about the amount of money in people's hands, because every $1 million borrowed 3 or 4 years ago was $80,000 in interest. Now it's probably closer to $30,000 or $40,000 in interest. So effectively, we've halved the cost of housing, halved the cost of money. And with that, people have bought aspirational housing. So we've seen some areas, the Cottesloes of this world, and some near city areas like the West Leadervilles, etc. And I'd be very interested to hear from the agents in those areas if they are listening today. That we've seen value lifts in the order of 20 to 30% in a very short period of time. At the same time, the investment grade areas and a lot of the cheaper areas, we haven't really seen investors in the market. And the investment side of the market, in some instances, have lifted very little at all. So when we talk median prices, we're talking about a huge range from 30 or 40% lifts through to very low lifts, if a lift at all. So it's a very hard measure to drag across there. The amount of money, though, obviously comes back to interest rates. And that's one of the things that's on our radar screen for the next 12 months and beyond. And it'll be really interesting to see what happens with rates, not just the Reserve Bank, but bank funding costs is the key, as I see, because the bank funding costs are going to increase quite significantly. And I think with that, there'll be a pass on through to borrowers, and the Reserve Bank won't even need to lift interest rates before interest rates actually lift. Have a look at the fixed rates as a case at point. Fixed rates already up, so probably, 50 to 60% from their base. And that means that our variable rates, if they lift a similar amount, they'll be somewhere closer to 5% in 12 to 18 months' time. So we're going to see the price of money lift. But the other side of the equation in any demand, it's always the number of people with the amount of money in their hands. And we've certainly seen the money in their hands increase, but now we might see a few more people. And that's what we're really interested in. And that's where it's going to be difficult to determine. If we go back, and our biggest business in Australia pre-pandemic was immigration, because per capita GDP was actually stalling or declining whilst GDP was actually increasing. So our 300,000 to 400,000 people that were coming into the country stopped overnight. If that starts up, and at what rate it starts up, how are we going to go? How's, for instance, I know we're not talking about Sydney, but Sydney's number of apartments have halved the number of constructions that happened there. Our pipeline's not geared towards that. Our building market's already full. Our builders are already full. The prices have already lifted. How are we going to supply when more people want housing, when our vacancy rates are really low, our rents are rising, and the number of properties on the market are really low? Where's the wriggle room? Where's the breakout, Tim?
That's a tough question to answer. If we jump on to slide 25, just have a look at the construction cycle across WA. It's pretty much going vertical. If you look at, part of this is home builder, of course. I'm referring to the graph on the right here. So in WA, the number of dwellings under construction, you can see there's a building boom everywhere. Okay, but nowhere's really seeing as sharp a rise as what WA is seeing, at least from that low base that the home builder surge started from. So we are seeing a lot more detached homes being built across the WA region. Obviously, most of that is in greenfield, so north and south of the city in your typical locations. But also, when you start to look at what Gavin is talking about, we've got labour markets are already very tight. We've got supply logistics have run into some bottlenecks. The net result of this surge in construction activity running headlong into supply constraints, of course, is an explosion in construction costs. And you can see it on the next slide. Nationally, we've seen about a 7% lift in construction costs across the board, but some materials, think about things like structural timbers, or think about some of the metal products used in plumbings and door fixtures and fittings, doorknobs, all that sort of stuff. They've gone up in value or price by more than 30%. So we are seeing some extreme challenges in the construction space that I think is probably going to constrain this new supply to some extent. For anybody who's embarking on a major renovation project or is building a new home, or if you're a builder, you're probably seeing this at the coalface. The fact that projects are probably taking longer than what they may have expected. Budget blowouts. A lot of builders who may have originally had a fixed price contract are probably feeling the pain now, and also hearing a lot more about coming towards those sunset clauses where builders simply have to recalibrate the costs involved in their construction projects. But if I could just flick back to one other slide, and it's just on your point of comparing Sydney back to Perth. This was on slide 13, thanks, Alex, where we're just comparing prices back to what they are in Sydney, right? And I thought this was a really interesting graph that really helps to explain this recipe for increased demand coming into WA. So remember, people won't come into a housing market just because housing is really cheap, like what it is at the moment in Perth. They generally need a job, right? So having this recipe of extremely low unemployment, 6% jobs growth, and extremely affordable housing is this magical recipe for getting more people coming across the border into WA. They couldn't do that up until now. So now that we've seen open borders and sure, COVID's running its path in WA like it has in most other areas of the country, but we are going to see more people coming across the state border. They're going to be coming into a marketplace that still has listing numbers that are around 30% below average. We're still seeing a shortage of stock, even though we are seeing a lot more new building happening at the moment as well. And they'll be very much attracted by this pricing differential, about 150% difference between Sydney prices and Perth housing prices, I think is a pretty compelling opportunity, especially when you consider the employment opportunities that are local in the WA market.
It's interesting too, because average wages are not that far apart between Sydney and Perth. The actual average wages in Perth are very high. So you've got cheaper housing and you've got high average wages. And for the first time looking on the jobs market, there's some really interesting jobs in Perth at the moment. And some of those include not just the mining industry, but other industries. So there's a unique opportunity to actually get a good job and a high paying job and have the cheap housing. That's a pretty rare combination of factors. Cost obviously does not equal value, as we know, and costs rising mean that if you don't get a commensurate increase in established housing prices, something's got to give. You just can't increase the building cost of a house, and it stops people building, quite simply. So if you can't also oversupply a market, you can't outbuild a market, and if you can't outbuild a market, you don't tend to get into that supply trough that we get on the other side, which is the bust cycle. And every boom that I've seen's been tailored by two things. One being we've had a building boom and you get a lot of homes being built and the quality becomes questionable as well. Two, though, you get a lot of investor activity. It's almost like everyone buys and invests at the top of a market. We've seen a very strong market. We've got very strong yields, some of the strongest yields in the Perth market in Australia. Yet we haven't seen the investors in the market in WA. And that's been really interesting, because that's a classic sign of the top of the market as well, where probably 40 to 60% of the sales that go through are to investors. At the moment, it's probably closer to, I don't know, somewhere between 15 and 20, if that. But, have you seen this cycle in other cities? Where are investors active in other cities, or is it just unique to Perth?
No, they're actually really starting to ramp up. Let's flick over to page 19, and we've got a bit of a view on what the investor trend is across WA, right? So we're looking at mortgage-related data here, right? This gives you a bit of an insight into the different segments of the marketplace that are either more active or less active. So the biggest segment of demand in WA by far, and this is the same everywhere, by the way, this isn't unique to WA, is what you might describe as subsequent buyers. These are upgraders, downgraders, downsizers, subsequent buyers, right? They're not first home buyers, not investors. By far the biggest portion of the market, and they're holding pretty firm in their level of demand. You can see that first home buyers have really started to fall away, just as they have everywhere else as well. Okay, this is a factor of not just affordability, which I've mentioned already is pretty practical and straightforward in WA. This is more a case of some of the incentives for first home buyers now expiring. A lot of first home buyers were pooling or aggregating things like home builder together with the first home buyer grant and the deposit guarantee. But obviously home builders expired, and we are seeing first home buyers, of course, being impacted by affordability to a lesser extent as well. The growth segment, absolutely in WA, is investors. But if we flick on the next slide, you can see proportionally investors in WA are only about 22% of mortgage demand, which is the lowest of any state. Go to somewhere like New South Wales, and for whatever reason, investors are still flocking into a marketplace that's the most expensive. Remember, the typical price to buy a house in Sydney is about $1.4 million, so massive buy-in price. It's got the lowest yields, so typical gross yield in Sydney is about 2.4%. In Perth, it's about 4.5%, so it's more than roughly double what it is in Sydney. And it's also a market where you've probably got more upside. You know, if you consider Sydney's growth cycle, it's very mature. In fact, the last 3 months, we've seen the Sydney housing market flatten out, whereas Perth is gathering a little bit of momentum. But on the other side, you can still see that in WA, first home buyers are the most represented. Remember that trend I showed on the previous slide where first home buyers were trending lower? They're still the largest proportion of the market across any state. And again, I think that really reflects the sheer affordability of housing in WA, along with some of the other state-based policies like Key Start and so forth, which are quite unique to the WA market.
Yeah, it's interesting. I mean, you can understand the investors always look for capital growth. The first-home buyers perhaps either want to get out from mum and dad's home, or perhaps the rents are rising and it's cheaper to buy than rent, and that certainly has pushed a lot of the first-home buyers into the purchasing market. Interestingly, though, 22% and 31%. Respectively for investors and first-home buyers, half of the market being new demand, as distinct from you and I selling homes to each other and borrowing more money and adding another zero on the end. When you've got 50% of your market being new demand, that is coming out of rental accommodation, coming out of home, or purchasing an investment property as a net increase, usually that spurs on values, and that's at the lower end. So if I was to pull a segment out at the moment that I think has got big upside for the next 12 months, it is the lower end of the market in Western Australia, and particularly Perth, where I can see values rising quite strongly in that sector. Whereas the top end, where the cheap money and the borrowing capacity has been used in the sort of maybe the $800,000 to $2 million mark in there, and even beyond above that, it has certainly been very strong. It's very hard to get good property at $1.5 to $2 million in Perth at the moment. And you try and buy it, it's difficult. You'll be competing against other people, and that's certainly that's the area where there's been the biggest lift over the last 12 to 18 months. So I think it's time for perhaps the investment grade stock to move along, and that might sort of then actually bizarrely drag down the median. If you have a lot of activity at the lower end rather than the upper end, you can actually drag down the if it's just a straight median house price by pure definition. I know that's not the way Core Logic calculate theirs. You might see those medians actually fall because of the amount of activity at the lower end. So be careful on the stats. If it's a straight median, understand what you're really looking at would be a key message for the next 12 months. Because certainly what I'm seeing on the ground is I'm seeing for a property available for rent, in most instances, 10 to 20 applications. For a good property at somewhere between $800 and $2 million, I'm seeing 2, 3, 4 people interested, and in many instances selling for above expectations, setting new benchmarks of value. And that's still happening today. I'm talking to buyers agents who have got 5 and 10, 12 people signed up looking for properties, and they're competing aggressively and actively trying to find those properties. That is also coming out of the Eastern Seaboard in part because recognise the value in Western Australia, recognise the high yields relative to interest rates and buying. And that often happens. That happened in 2003, where we saw New South Wales buyers jump into Western Australian market, catch the locals napping, and we had a huge run-in for the next 5 years in Western Australia. So it's a positive sign when you're seeing value outside of the market, because that's often where it comes. At the same time, also in the market on the ground, I'm seeing areas that are way out of alignment. It's really interesting, and this goes to a first home buyer and an investor, and the points you make there, Tim. It's not the overall market, but I'm seeing a market like, for instance, a West Leederville or a Wembley, for instance. Near city, really good areas, really benefited from a number of things that have happened, including the Bob Hawke College. Beautiful housing, near city. Anywhere else in Australia, be it Melbourne or Sydney, if it's in those areas, probably worth 3 or 4 million, currently sitting at 2 in Perth. At the same time, one of the long-term performing areas in Perth has been an area like Triggs in North Beach, near the coast. We have a love affair of the coast in Perth. And yet the same property in Triggs might be 1.4 million. And normally, all things being equal, if it's $2 million in West Leederville, it's probably going to be $2 million in Triggs, yet there's a big misalignment, big hole in the market there. So the question is, West Leederville going to come down to 1.4? I don't think so. More likely Triggs is going to lift to the 2. And over time, that alignment will come back. But there's certainly not alignment across our suburbs at the moment. Interesting to see how that plays out in the stats over the longer term, Tim.
Yeah, I wouldn't be surprised if just extending your commentary there, if we do actually see that growth trend extending more into some of those coastal, more regional markets as well. That's absolutely a trend we've seen around the eastern seaboard, where your regional markets that have some lifestyle appeal, for example. Byron Bay is probably a classic example, or Noosa, the Gold Coast, but even areas, like Sydney's Northern Beaches or the Central Coast are really good examples, which have absolutely boomed. If you look at the top 30 areas for growth around the country over the past 12 months, probably the first 20 of them, you could loosely describe them as either capital city or regional coastal markets. We are seeing that trend to some extent in WA as well. So markets getting down towards Bustleton and Bunbury and the Margaret River are probably your local examples, but also even areas getting down towards Mandurah, which still seem to be quite affordable compared to where they were back in, say, 2006, you'd have to think would become more appealing as well, considering relatively decent transport infrastructure connecting that area, the very low pricing, and the fact that more people can actually work remotely these days. We are seeing a lot more companies adopting permanent hybrid working policies if they're in the sort of industry that's appropriate for.
Yeah, I do see that work to live type and work from home trend having some legs and continuing. Some of the regional markets, though, have been bought by money that normally goes to France for a month and buy a holiday home, and then perhaps in 2 or 3 years' time, maybe we don't use a holiday home as much as we thought we would, because now we're going back to France or Spain or wherever it may be, and perhaps that holiday home is past its use-by date very quickly. So some of the regional markets, I would probably caution people just to make sure that you're buying property that the locals can afford. If the locals can afford, normally it's a pretty healthy sign for that market. Absentee money driving prices sometimes can dislocate. We've seen that happen before in places like Karratha, etc. And Karratha going really strong at the moment. I just want to jump around a little bit. I know we have jumped into interest rates and we're back out of interest rates, but the one question I get asked, I don't know how you go, Tim, what's the impact of rising interest rates going to have on the housing market? And I know that there's two factors here. There's the fact that people are being assessed at being able to pay between 2 and 3% higher interest rates, whether they know it or not, with every loan application that's made or every refinancing application that's made. So the fundamentals there that people are assessed at being able to afford higher interest rates. What I've seen, though, in the past with interest rates, it's more a confidence and a psychology. And it's really interesting that the fear of interest rates rising sometimes stalls the market. The first interest rate rise sometimes has a bit of an impact on the market and moves through. The second one, people digest very quickly. By the time you get to the third or fourth, people are starting to be scared about interest rates going to 17% again, and the confidence factor drops and it all stalls. What's your read on interest rates and how that's going to play out in the market in the next 12 to 24 months?
Well, let's jump onto the interest rate slide. That's on slide 29. And we've done a bit of work on this, obviously, with a lot more commentary and speculation that rates are going to rise later this year. We've looked at the correlation between housing values and the cash rate, which, probably unsurprisingly is a very close correlation, or close inverse correlation. It's about an 85% correlation. It actually strengthens with a lag. So 12 months down the track after the first rate hike, you actually see a much more substantial response in housing values in the opposite direction. So I think at this point of the cycle, households seem to be a lot more sensitive to the cost of debt, probably because we do have a household sector in Australia that's at record levels of indebtedness. And most of that debt is housing-related debt as well. The latest household debt to income ratios are only up to September last year. We'll see the December data coming up pretty soon. But it shows that housing debt to income and owner-occupied housing debt to income have never been this high. And chances are they've already increased further from where they were in September. So my guess is households will be more sensitive to not just the rising interest rates, but also just the prospect that interest rates are going to be rising. Looking at some of the indicators of consumer sentiment, and particularly housing sentiment, probably one of the better measures is the Westpac Melbourne Institute monthly consumer sentiment survey. You can already see that time to buy dwelling index has reduced quite sharply. In fact, it's back to the lowest levels we've seen since the GFC. There's a lot of factors driving that. It's not just concern around interest rates. It's also things like the Russian invasion of Ukraine, it's the recent weather events and the widespread flooding, it's rising cost of living as well, which of course is one of the factors that's likely to be pushing up interest rates. But there's a lot of other factors that affect markets as well. Interest rates is probably one of the big three. The other ones that we know, of course, are access to credit. We saw the impact of tightening credit through the last, at least East Coast downturn, which ran between the middle of 2017 and the middle of 2019. And that period was characterized by macroprudential controls coming in to try and curb investment activity and interest-only lending activity. But more importantly, it was also the Royal Commission, which really saw lenders tightening up their lending policies and their willingness to lend on, say, high debt to income ratios or where household budgets had already been quite stretched. The other factor, of course, comes back to economic events. We know, events like the GFC or a stock market crash can have a fairly profound impact on housing level activity, again, because it impacts on sentiment quite sharply. We know that sentiment levels broadly and housing market activity have a pretty close relationship.
Yeah, it's interesting with interest rates where they are at the moment. I think people genuinely believe that interest rates are very low, and they're kind of thinking that an interest rate below 5% is unsustainably low. So people, I give people credit for being very smart. In the lead up to the GFC, the lead up to the pandemic, people started saving money before anything else happened. I think people are very prudent. There's 500 billion or thereabouts on deposit that people have saved over the last couple of years, and that's been very cheap funding costs for the banks, but it's also giving a big buffer to the market. I know also in LVR terms, I know a third of the people own their homes outright, and I know that the overall LVR, loan to value ratio in the whole market is probably a $2 trillion debt, roughly on a $9 or $10 trillion market. So we've got if your balance sheet was $2 trillion worth of debt, but you had $10 trillion worth of asset, you'd be in a very good position. And that seems to be the Australian housing market across the board. So there's going to be some weak points, but it's not the whole market as I see. And I know you're always led by your weakest link, and I know that can have a knock-on effect, but I just don't think it's going to be a catastrophe, even though every recession I've seen has been rising interest rates, and 12 to 24 months later we get a recession because they raise interest rates too much. Because by the time the last one's raised, the first one's having an effect, and it's already pulled the market backwards. And I'm also respectful housing markets obviously run at the end of the cycle. We make money in dividends, bonuses, profits, wages, and then we buy a bigger house. And normally it's the end of the cycle market that runs the housing market, which is actually not an investment market. It's people just buying homes to live in. And yet it's 4 times larger than the superannuation pool in dollar terms, and 3 or 4 times larger than the share market. So that's why in dollar terms, it is a very significant market in Australia. I'm mindful of just, we've got probably 10 minutes left, and I do want to see if we have any questions come through, an opportunity to answer what people are listening, what they may want to hear outside of, we can chat all day, Tim, I know that. We can go on, we haven't even got to the policies yet, and policy changes. There's some interesting things there. They're going to affect the market as well. But if anyone's got questions, now's the time to send it through. Or if you've got comments, send it through so we can actually get to them and have a look. While we're waiting for those to come through, though, policy changes. One of the policy changes we're seeing in Western Australia, and we've seen a significant shift. We've seen something like 8,000 properties on Airbnb shift in 2012, shift to probably more like 20,000. And there's some legislation being proposed at the moment that may shift that back, shift some of those back into the rental market. We've only got 2,000 properties available for rent. So if we saw an incentive policy that incentivised people to shift back from Airbnb back into the long-term rental market, we could actually blow our vacancy rates out very quickly, because people have been making a lot of money out of the Airbnb market. Space to watch that space. The other one to watch in Western Australia particularly is the medium density code coming out towards the end of the year. There's some really good opportunities in there that's going to really reshape how the mid-range and medium density occurs. So watch that for opportunities. If you're looking to invest, that's one thing you want to know about as well. So from a national point of view, though, Tim, policies that you see that may affect the housing markets across the board?
Yeah, there's a few coming up, and obviously coming towards a federal election where we are expecting there will be some fairly specific policies aimed at boosting home ownership in Australia. Haven't seen any just yet, even though the election's probably going to be in May. My guess is both of the major political parties will be quite heavily being debated on home ownership and getting more first home buyers back into the marketplace, improving affordability. We know that's fairly topical amongst the constituents. So watch that space. My guess is most politicians would generally tend to throw more money at stimulating demand, rightly or wrongly. So that means probably more leg ups for first home buyers, potentially an extension to the deposit guarantee, that type of thing. But arguably, it'd be great to see more policies directed at things like actually structurally improving affordability. So by that I mean actually more housing, more land for housing, more infrastructure to connect up areas that aren't maybe as desirable as what they could be, where housing is very affordable. Another policy initiative that I think will be probably ahead of us, of course, is interest rates, monetary policy. We did see the Reserve Bank governor talking last night. I know we already talked about interest rates, but it's kind of timely. We saw the RBA governor make a speech yesterday where for the first time he pretty much conceded that interest rates could rise later this year. And he did make the statement that it would be prudent to start planning for that. So I think the writing's on the wall there as well, that we will see a major policy shift around monetary policy, cash rates starting to rise, not because of the current trends, well, partly because of the current trends, but I think more so the fact that inflation is really expected to start rocketing on the back of things like higher fuel costs, as we see the cost of oil skyrocketing as well. US inflation figures came out overnight and they're seeing annual inflation up above 8% now. So if that's anything to go by, it looks like Australia's rate of inflation is going to be well above the RBA target range. And the RBA will be trying to fight that fire as practically as they can. Of course, trying to walk that tightrope between higher rates and making sure they're not causing a housing market blowout.
Yeah, very interesting. I'm just looking now. If we go into our questions, they're all coming through thick and fast now. So thank you very much for sending those through. Are there any areas in Perth that have overpriced themselves and will lose out to other areas of opportunity? You mentioned. Look, I don't know. I don't necessarily think they're overpriced, but I think there's some very underpriced areas, relatively speaking. And if I look at somewhere close to home, one of the top performing markets has been Cottesloe, for instance. Don't see it as being necessarily overpriced, although there's some real breakout prices there. But I look at Peppermint Grove and I think it's undervalued, relatively speaking, to Cottesloe. I've mentioned the Triggs and near City as well. So, that's sort of another area. I see Fremantle as being very undervalued as well, even though that's lifted. Looking at the next question, given what are the future of Donsbury and Bustleton, Margaret River, obviously they've suffered from the tourism side, but they've been supported very strongly by people buying holiday homes. There's still a very strong demographic push, and that's one thing that we haven't got to, Tim, is the demographics, but there's a very strong demographic push into ageing population, retirement, lifestyle in Donsbury and Bustleton, so I expect that to continue on. What are we looking at? Are you going to talk about block or land prices predictions? I have one for sale, a subdivision, the house sold in 24 hours, the block hasn't had a bite. Yes, very good question, Lisa. This is agents are reporting that's hard to shift blocks, mainly because the building market is very difficult to supply at the moment. But that will free up. Have a look at the Baltic Dry Index on that. Would be my tip, that blockages around the world are freeing up. And we will see a freeing up in supply of materials, I believe. And if I ran a construction business, I'd be looking to target bringing the right trades in, not just from interstate, but from overseas. So I think that with borders open will assist as well. Housing prices, Bunbury, Bustleton are very low now. Yes, they are. I agree with that. Always a good time to buy when they're low, not when they're high. Projection 5 years, Bustleton Airport opens. Yes, have a look at what happened to Broome with the Bustleton Airport and the Broome Airport. You'll see a very, that southwest will kick along extremely well. If you can fly directly in, from Melbourne into the southwest, you're going to see tourism go to another level. So we saw it happen in Broome. I see no reason for it not to happen in Bustleton. What else have we got here? Where do you find out about medium density changes? Landgate, yes, look at the Department of Planning website. Good question. Well worth reading through that legislation. It's out for comment. Tim, with the proposed $65 billion in projects coming online in the Pilbara up until 2026, where do you see the market being in the next 12 to 24 months? Will we see a similar boom and bust scenarios faced previously? That's from Adam.
Yeah, you've got to expect these markets are generally more volatile than others. Infrastructure is what drives them rather than commodity prices generally. So it's great news for these areas that infrastructure is picking up. That creates jobs. Remember, standard rule of thumb: 4 people to build a mine, 1 person to operate it. 10 to build a LNG, 1 to operate it. So making new infrastructure is where it's at, and that's going to drive jobs. After the infrastructure is done, though, then those jobs generally become less available. So I'd still be a little bit cautious around some of these mining regions. Absolutely, they're returning huge yields at the moment. Rents are skyrocketing. Most of the commodity-based companies are insisting their staff are either local or driving in, driving out rather than FIFO. It's just too much uncertainty with COVID around that as well, which has really boosted housing demand against a backdrop of short supply as well. But also another word of warning there is lenders are still pretty cautious around lending into a lot of those mining specific markets, just because of what we saw through the last crash. Yeah,
very, very good point, Tim. Absolutely. You were actually seeing a number of questions come in, and we've got a couple of minutes to go. Just higher US inflation. Very interesting around the job participation rate. I think that we saw the US job participation rate increase over the last, or decrease over the last 12 months. Ours increased. They faced the pandemic, COVID in reality. We didn't. Perhaps our labour participation rate might actually fall through the year, and wages growth is going to be alive and well. Wages growth might just offset a lot of movement in interest rates, and watch that space. If we do get wages growth, we will get more inflation. But at this stage, the US is the capital of inflation globally. Australia doesn't seem to have had that as yet. But rising US interest rates will have a direct knock-on effect to the cost of funds globally. Cost of funds for banks to raise their funds at the moment, 60% comes from deposits. If those deposits start getting spent, the banks will have to tap the international markets for more money, and that money will be more expensive, and that will put the price of funds up, and that will put the cost of interest rates up accordingly. So watch that space. Look, we've got just a quick minute left. Tim, final comment, Perth market, 12 months. What do you see as an overall, if you had to throw a dart, what is there a number you're forecasting?
I'm not forecasting a number, but I think Perth will be outperforming the broader marketplace, put it that way. I think the smart money will be looking at Perth because of its high yields and its capital growth potential, and simply a very affordable buy-in price as well. It's hard to see this marketplace going backwards once again with the fact that prices are as low as what they are. Very surprised to see investors as low as what they are in WA so far. So I think as soon as we start to see that really hitting the radar, investors tend to have this herd mentality. And once we start to see more investment demand coming in, more will follow, is my expectation.
Yeah, I tend to agree. I think we haven't seen the investors hit the market yet. When they do hit, that'll really push that end of the market along quite strongly. Rents are very strong, and rents ultimately are the insurance policy to your values. So whenever I make an investment, I look at the upside potential versus the downside risk. Downside risk I see is very minimal because building costs rising, rents and yields very strong. I can see perhaps more upside potential than downside risk. And usually when I see more upside potential than downside risk, I make the investment. So, with that, look, I'd just love to say it's been a pleasure speaking with you, Tim, as always. I know we could talk for a long time. I know there's a lot of points we haven't covered. And I know that you're an absolute wealth of information, and I think that we could have tapped into that even further. The challenge was we had a limited amount of time, which we are now out of. So lovely chatting with you, Tim, and thanks so much for your intellect, your manner of putting it forward, and the clarity with which you put it forward as well.
Thanks, Gavin. It's always a pleasure, and I look forward to when we can actually get together and have a beer and the borders are open.
Well, I'd have to take up drinking for that because I don't actually drink alcohol. So I'll have a squash and beer and we can have a chat. So yeah, I look forward to that too. Thank you for your attendance. I'd now like to hand over to Paul Miodoni from the agency for his closing. Thank you.
Well, that was magnificent as always. Thank you, Gavin. Thank you, Tim. Your insights are invaluable. You've provided a lot of information. I'm feeling quite positive about the real estate market going forward, but it's changing very fast, and it's a shame we've got to stop it. I know you guys can talk about this for hours, and I can tell you we can listen to you guys for hours as well. The number of questions were overwhelming, so thank you everyone for participating. It's unfortunate we have to close it, but I think with that and the speed that this market is changing and moving, would look at hopefully having another seminar maybe as early as possible in 6 months. And hopefully this time it will be one that we can all be face-to-face in a function centre where we don't have to rush off or log off. I'd like to thank the AICC for giving us this opportunity. As a chamber, in my view, and I've said it before, I think the AICC is one of the best business chambers in the city. If you're looking for a place to network, if you're looking for a place to be able to come and hear and see great speakers, there's no other chamber like it. I'd highly recommend that you look into joining the AICC. I'd also like to thank all our sponsors. So the Property Tribune, PKF, Bendigo Bank, Mortgage and Finance Solution, Living Online, the WA Italian Club for getting involved with this event. We were supposed to have it at their function centre. Hopefully we'll be able to do that later on in the year. Chestnut Grove, particular Dave Tasker and his team at Chapter 1 for the technology and hosting the Zoom call. Thank you very much, guys, and to Schaefer Corporation. I hope you've all got something out of it. I hope you've all enjoyed it, and thank you very much for joining us. Have a good day.